Welcome back. Management fees. Nearly every type of alternative investment is subject to them, as are most investments like mutual funds. So the question, of course, is how should the fees affect how you invest? David Kaufman is president of Westcourt Capital. Great to have you here.
Thank you.
And am I right in thinking that for the most part in the alternative world, the fees can be phenomenally higher than in, for instance, ETFs, mutual funds, where they're kind of more accessible to the public?
Well, it's certainly higher than ETFs, because ETFs, by and large, are not actively managed, with the exception of a few that are out there. So, but among actively managed mutual funds and the kind of funds that are generally used for investors in alternative strategies, the total MER, so the management expense ratio, would be a little bit on the high side, but within the same sort of 2 to 3% range that you see with some of the general mutual funds.
Let's talk about where fees were 5 years ago in eclectic asset classes like hedge funds. They were legendary for how much they sucked out of the client's account. The traditional was 2% management fee plus 20% of any profits. And that worked for a while while everything was going up. Then they all blew up. That seems to have gone away now. Now they're struggling to try and maintain those fee levels. So we're starting to see compression in that asset class. Where we haven't seen it yet, and I'm trying to champion this at O'Leary Funds, is dropping the fees on mutual funds. That's where we all need a break, because that's where the majority of the money is. How's the industry doing?
Well, it is true that they've had a pretty massive change in the hedge fund world. And in the mutual fund world, most people in Canada don't realize that Canadians pay generally much higher MERs, total fees, than anywhere else really in the industrialized world. But I think that you're starting to see a change in that, and you have firms such as Alpha Pro, who have actively managed discount mutual funds, and firms like yourself who are coming out and saying, we have to do something about this, because on the margin, on the extra $100,000 on a $100 million fund, it's a little bit difficult at that stage to justify the 2.8 or 3.2% MER, because the marginal cost is not that high compared to the fees that are collected for that marginal money.
Now, theoretically, the larger a fund company gets, the more critical mass they have, the lower their fees should be. So you would think the industry would consolidate very quickly. It hasn't happened. Why is that the case?
Well, fund managers, like everybody else, work for money. And while it's very difficult to say, if you think about a fund manager like, say, a bus driver, bus drivers don't get paid extra for the extra passenger that hops on at the last minute. And yet, as you just said, the fund manager does collect more fees for the extra money that comes in. And I just think that the simple reason that that hasn't happened is that fund managers need to get paid, and they like to make a lot of money, which I can't blame them for. And so if the people are willing to pay it, they're going to continue to charge it.
There are a couple of different ways fees are structured, right? You can pay a performance fee, or you can pay a piece of the assets under management. Which one makes more sense? That's
a good question, because at first blush, most people would say that performance fees make sense because you have your skin in the game and your interests are well aligned. Lately, we've seen a lot of new funds which are income funds, yield funds. And I have a big problem with yield funds that charge performance fees, because what you're doing is you're incentivizing the manager to take on extra risk to try and push from 7 to 8 to 9%, because they're getting a pretty big cut of the difference, largely to the detriment of the investor for whom capital preservation and moderate growth and moderate income was the goal. And the flip side of that is that they typically are accompanied by relatively low fixed management fees. Again, you think that sounds so great, but the issue there is that if you're barely making enough to eat on the fixed fee, then it's going to make you possibly undertake even more risk to get that performance fee so that you can really cash in.
Let's ask about the philosophy underneath what a performance fee is. Why in the world would you ever give money to a manager that's asking for a performance fee? My question is, if you love performance, put your own money in your own fund and get performance, and stop trying to gouge it from the investors. Doesn't that make more sense?
It does. First of all, I should say that in the alternative world, most managers put very significant amounts of their own capital in their own funds, and that should be one of the first questions that someone does while they're conducting due diligence. But on the other hand, that having a large performance fee there does align interest to a certain degree, and in the end, I think that what a manager would say if they were sitting right here is, look at the net numbers. Yep. And if net on a historic basis, audited results, net of the fees, including the performance fees, there's alpha generated, meaning that there are returns that are outsized compared to whatever benchmark you're comparing that fund to, then it's still worth it, even if those fees are exorbitant from a traditional point of view.
David, always great to have you here.
Thank you.
David Kaufman, president of Westcourt Capital. Time now for our priceless moment.